Central banks are the backbone of a country's financial system, responsible for maintaining economic stability and promoting financial well-being. As the lenders of last resort, central banks provide a safety net for the banking system, ensuring liquidity and preventing financial crises. Through their monetary policies, central banks can influence interest rates, inflation, and the overall health of the economy. By regulating the banking system, central banks ensure that financial institutions operate responsibly and in the best interests of the public. The modern central bank, with its glass walls and sleek decor, symbolizes the transparency and professionalism that are essential for effective monetary policy and financial oversight. Central banks are the primary monetary authorities responsible for a country's monetary policy. They oversee the banking system, regulate financial institutions, and ensure financial stability. Central banks issue and manage the national currency, controlling the money supply and exchange rates. Their policy decisions aim to maintain price stability, promote economic growth, and support full employment. The origins of central banking can be traced back to ancient civilizations, where temples and palaces played an early role in providing credit and managing monetary systems. The Bank of England, founded in 1694, is considered the world's first modern central bank and served as a model for the development of central banking globally. Many countries followed the example of the Bank of England in the 19th and 20th centuries, establishing their own central banks to manage monetary policy, promote economic stability, and support national development. Central banks have evolved over time to play a crucial role in the financial systems of their respective countries. The primary objectives of central banks are to maintain price stability, promote economic growth, ensure financial stability, and support exchange rate stability. Price stability is crucial to preserve the purchasing power of the national currency and keep inflation low and stable. Central banks aim to foster sustainable economic growth and employment through appropriate monetary policy decisions. Ensuring the stability of the financial system and preventing systemic risks is a key responsibility of central banks. Maintaining a stable and competitive exchange rate supports international trade and investment. These four objectives, price stability, economic growth, financial stability, and exchange rate stability, are the core focus areas for central banks around the world. Interest rates are a key monetary policy instrument that central banks use to influence the cost of borrowing and saving, which in turn affects the level of economic activity. Central banks conduct open market operations by buying and selling government securities to adjust the money supply and steer short-term interest rates. Reserve requirements mandate that banks hold a certain percentage of their deposits as reserves, which allows central banks to control liquidity in the banking system. Capital requirements set minimum capital ratios for banks to ensure financial stability and resilience to shocks. Together, these monetary policy instruments give central banks the tools to manage economic conditions and achieve their policy objectives. Central banks set key interest rates like the federal funds rate or policy rate that serve as benchmarks for the broader financial system. Changes in these benchmark rates influence a wide range of other interest rates, affecting investment, spending, and economic activity. Adjusting interest rates is a primary tool for central banks to influence inflation. Higher rates discourage borrowing and spending. Interest rate management is used to stimulate the economy during recessions or cool it down during periods of overheating. This allows central banks to help stabilize the economy and promote sustainable growth. Inflation targeting is a monetary policy framework where the central bank sets a clear, numerical target for the inflation rate and then implements policies to achieve that target. The primary goal is to maintain price stability and anchor inflation expectations, which supports economic growth and financial stability. Central banks use tools like adjusting interest rates to influence inflation and steer it towards the predetermined target. Inflation targeting relies on clear communication and transparency, as the central bank must explain its policy decisions and the reasoning behind them. This framework provides accountability, as the central bank's performance can be evaluated based on its ability to meet the inflation target. Exchange rates are closely monitored by central banks. They intervene in foreign exchange markets to stabilize currencies and maintain orderly market conditions. Central banks communicate their exchange rate strategies and policy decisions publicly. This provides transparency and helps guide market expectations. Central banks also collaborate internationally to align exchange rate policies and prevent competitive currency devaluations. This international cooperation is important to mitigate risks and ensure stability in the global financial system. The central bank's primary responsibility is to safeguard the overall stability of the financial system. This involves closely monitoring the markets to identify and mitigate potential risks that could disrupt the smooth functioning of financial activities. Central banks employ macroprudential policies, such as regulating capital, leverage, and liquidity requirements for financial institutions. These measures help address systemic risks and build resilience in the financial system. Central banks also play a crucial role in crisis prevention and management, acting as lenders of last resort to maintain stability during times of market stress. By fulfilling this financial stability mandate, central banks help foster confidence in the broader financial system, which is essential for economic growth and development. Banking supervision and regulation are critical functions of central banks to ensure the stability and soundness of the financial system. Prudential oversight: central banks closely monitor the safety and soundness of banks and other financial institutions to identify and address any risks that could threaten financial stability. Capital requirements: central banks set capital adequacy rules that require banks to maintain sufficient funds to absorb losses and withstand economic shocks. Risk management: central banks mandate that banks implement robust risk management frameworks to identify, measure, and mitigate various risks, such as credit risk, market risk, and operational risk. Consumer protection: central banks enforce regulations to protect consumers from unfair or deceptive banking practices, ensuring fair treatment and transparency. The central bank's role as lender of last resort is crucial for stabilizing the financial system during times of crisis. By providing emergency liquidity to banks and other institutions, the central bank can prevent a broader systemic collapse. This function helps stop bank runs, which can have cascading effects across the financial system. Reassuring depositors is key to preventing runs. Maintaining public confidence in the banking system and financial stability is crucial for economic growth and development. The lender of last resort role is a critical tool for the central bank to promote financial stability and resilience. Payment systems are critical infrastructure that facilitate the flow of funds throughout the economy. Central banks play a key role in overseeing these systems to ensure they operate smoothly and efficiently. They closely monitor payment and settlement activities to identify any potential issues or vulnerabilities. This allows them to take action to mitigate systemic risks that could disrupt the broader financial system. Central banks also establish rules, guidelines, and regulatory oversight to promote safety, soundness, and transparency in payment systems. This helps maintain public trust and confidence in the financial infrastructure. Foreign exchange reserves are assets held by central banks, denominated in major foreign currencies, to promote financial stability and support the domestic currency. Central banks actively manage their reserves, accumulating assets to build up these holdings. Reserves are strategically invested in a diversified portfolio to generate returns while mitigating risks. Central banks closely monitor exchange rates and intervene to stabilize their currency when necessary. Maintaining the safety and liquidity of foreign exchange reserves is a top priority. Reserves are stored securely and can be quickly accessed to address balance of payments issues or provide emergency funding. Monetary policy set by central banks has far-reaching effects on the economy. Key policy rates like interest rates impact a wide range of other rates across the financial system. Changes in interest rates then affect the valuations of stocks, bonds, real estate, and other assets. Monetary policy also influences exchange rates, which impacts trade, investment, and inflation. The availability and cost of credit for households and businesses is shaped by central bank actions. Central bank communications are crucial as they shape public expectations about the future path of the economy. Understanding this complex transmission mechanism is vital for effective policymaking. Central banks today face a complex and uncertain economic landscape, with constantly evolving factors that make policymaking challenging. Balancing the key objectives of price stability, full employment, and financial stability can involve difficult trade-offs that central banks must navigate. Central banks must maintain a delicate balance between independence and accountability to government stakeholders, navigating political pressures. The rapid pace of financial innovation requires central banks to continuously adapt their policies and regulatory frameworks to keep up with technological disruptions. The central bank's dual mandate is to maintain price stability and promote economic growth. This can create challenging trade-offs. Lowering inflation may come at the cost of higher unemployment, while stimulating growth can lead to higher inflation. Central banks must use policy tools flexibly and pragmatically to strike the right balance and respond to changing economic conditions. They need to carefully weigh the impacts on inflation versus employment when making policy decisions. Finding the sweet spot between price stability and economic growth is an ongoing challenge that requires nuanced, adaptive policymaking. Central bank independence is crucial for effective policymaking and maintaining economic stability. It allows policymakers to focus on their mandate of price stability and growth, without undue political interference. Independent central banks have the authority to set monetary policy instruments like interest rates without direct government control. This insulates them from short-term political pressures and enables more consistent, effective policymaking. Central banks also have operational autonomy to determine the tools and strategies they use to achieve their objectives. At the same time, central banks are still accountable through reporting requirements, legislative oversight, and public communication of their decisions and rationale. Central banks must balance their independence with accountability to the public and elected officials. Regular public disclosure of monetary policy decisions, economic projections, and policy rationale strengthens transparency. Engaging with the media and public through press conferences and speeches allows central banks to explain their actions and decisions. This helps build public trust and understanding of the central bank's role and policies. Central banks strive to communicate their policy decisions, economic forecasts, and rationale clearly and transparently through press conferences, interviews, and public statements. Effective central bank communication involves actively engaging with the public, financial institutions, and other key stakeholders to explain policies and foster understanding. Central banks utilize digital platforms like websites, social media, and interactive tools to disseminate information and enhance public accessibility to their analysis and decisions. Central banks globally are exploring central bank digital currencies, CBDCs, to modernize payment systems and adapt to fintech and cryptocurrencies. Blockchain technology is also being investigated for use cases like cross-border payments and financial stability monitoring. Central banks are focusing on enhancing their data analytics capabilities to gain deeper insights from the information they collect. This enables more sophisticated monetary policy decisions and helps mitigate emerging risks in the financial system. Central banks are critical institutions that shape a nation's economic stability and growth, making their policies and decisions crucial for businesses, consumers, and the financial system. Central banks must carefully balance their primary objectives of price stability, full employment, and financial system stability, which can sometimes require difficult trade-offs. As the economic, technological, and social landscape evolves, central banks must adapt their policymaking and communication strategies to remain effective and responsive. Increased transparency and accountability have become essential for central banks to maintain public trust and ensure the successful implementation of their policies.